following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network. And if my voice sounds a little bit deeper and perhaps a tad more lustrous this week, it's because I am nursing a cold. So all of this endless talking is certainly the best thing for me to be doing this week. But thankfully, I am not alone on the old Volatility Views panel today. I am joined by my cohorts, my partners in crime, starting off with the man from Volex, none other than Don Schlesinger from the Volatility Exchange. Don, welcome back to the show, sir.
Always a pleasure to be here, and we continue to bask in this non-winter 40 and 50 degrees sunshine, wondering if it's ever going to end.
I like that's a good term for it, non-winter. I could do with a little bit more non-winter from my own perspective. I've had enough winter for the last me for a while, I think. But then again,
I'm sure the ski resorts aren't too happy, at least in the east.
Exactly. I'm not a degenerate skier, so I don't. I gave that up a long time ago. So I don't mourn the lack of snowfall. And we are also joined on the program today by the man from the pit, a.k.a. Mr. Slinky, a.k.a. Mark Sebastian from OptionPit.com. Mr. Sebastian, welcome back to the show as well, sir.
Yeah, I'm doing great. Thank you for having me. It's great to be here with the legend, Don Sold to You Schlesinger, and of course the cold yet deep voiced Mark Longo.
Well, I do what I have to do, and of course, and we are also going to be joined momentarily by another fantastic guest, Simon Acomb from Acomb Financial Research. But listeners, you have to stay tuned a little bit for that, because first we're going to dive right into the Volatility Viewpoint.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review segment. This is, of course, the portion of the program where we discuss the week's worth of action from a volatility perspective. And, we've discussed on several recent programs the phrase, how low can it go? If volatility was indeed a game of limbo, how low can the pole go? And we've said many times that it could keep going lower, and the VIX and volatility certainly reinforced that over the past week. We are dancing around the 17 handle right now in the VIX cash as we are recording this. VIX cash dancing at 1710, down nearly another 5% today. Of course, you have some weekend effect going on there, but still, the VIX just
we're finally where we belong, Mark.
I had a feeling you were going to say that.
If you look at the last couple of days, we've had an uptick in realized volatility and a downtick in implied volatility. If we just threw today into a vacuum, the S&P is up about 1.3%. That equates to a VIX of, that is a realized vol of, 1 second here, I'll let you know. I know, look at me quoting. Today we're actually trading in movement terms more than the VIX, close to 20. This would be about a 20 VIX, 1.3%. But the fact that the VIX, that S&Ps are now moving closer to 1%, which would be realized volatility about 15.87%, 16%, and the VIX is around 17%. That puts us kind of, if that's where we are, that is a normal market. Realized volatility in the 14, 15, 16 range, the VIX around 17. Weekend decay puts us at 18. It's right where we actually should be. Things are finally starting to fall back in a line.
So that's it. We should just take a snapshot and we're done. We can go home. We
Done.
finally reached
Mark's
perfect
not doing
equilibrium.
anything the rest of the year.
We finally come off from the irrational exuberance of the high 30s in the VIX cash, and of course the low 20s in realized vol for the S&P, and we finally found this nice equilibrium here around this level. So that's it. We're pretty much done. And forget selling May and go away. Selling
8% in realized volatility, I think, is the important thing. The VIX has always been taking the slow ride down. Realized volatility actually got kind of Don mean reversion Schlesinger would say, got kind of oversold. I mean, we stopped moving, and something had to give there. And I think the last couple days we're starting to see it. Stop me if I'm telling tales outside of school there, Big DS.
Well, the thing that's so interesting, that's quite remarkable, although, with a day like today, obviously it's going to log a data point for realized volatility, which, as you say, equates to about 20 or 21. But I think it may come as a surprise to you and just about everybody that the last 21 days, if you do a 1 month on the calendar or 21 or 22 trading days of realized volatility. We're not talking VIX. We're not talking implied, talking about how the market moved for the last month's worth of trading. I think you'd be astonished to learn that S&P realized volatility was 6.73. It's about
that low?
It's about the lowest level that I've seen since the late 1994 that I recall at the end of the year. NASDAQ was about 8.43 for the past month. And with it all, the actual volatility of that number, as often is the case when it's a very small number, so that even jumping around a little bit can produce a big volatility, was 162 for the. So you had this low vol number, but the volatility of that number was extraordinary. And this compares with very long term, going back 25 years or more on the S&P of average 1 month historical volatility, the numbers that we're all familiar with, 16.75. So we really have an extraordinary situation now where even as VIX drops, and even as we see sub-20 readings in the 17s or 18s, which everybody says, wow, how low can it go? We've actually had realized volatility on the S&P, not only in the single digits, but, 6 3/4. So there still is this disparity, this risk premium, if you will, between options implied and VIX futures, and what realized volatility actually has been. And obviously,
well, you're going to get a nice uptick in the 1 month in the 1 vol today.
That's right. And what you're going to have is that, that's really unsustainable to have single digit realized and, 18 implied. So they're going to have to close that gap of risk premium that we've spoken about so often. And I suspect it might close by a little movement in both directions. You may actually have VIX dropping some more while realized come up, so that those historical levels of 3, 4, 5% risk premium would prevail once again. And people sometimes say, how is that going to happen? Is VIX going to drop? Is realized going to go up? I think in this case, the answer is all of the above.
Hey, John, did you see Bob Pisani quoted you guys in his little blog yesterday?
No, as a matter of fact, I didn't. So I'll be happy about it.
Historical volatility, how much the market has actually moved over the last 21 days, is that a little under 8.5. He was obviously using the day before his Garch. And then it says, according to Volex.
Hey, that's good to know. I'd like to see that clip.
It's right in his blog. I posted the link in our Skype. So
there you
thanks
go, Don.
for letting us know that.
You're famous.
Yeah. So you're it's you guys are getting the name out there, and I think you're going to get a nice uptick back over. And one of the things you have to remember is that, in theory, option prices are forward-looking and realized volatility is backward and currently looking. And, yesterday was an absolute disaster of nothing. But 2 out of the last 3 days would be an uptick in over 8% vol that the one vol had been kind of reading over the past couple of weeks. So I do think that we're getting an incremental uptick in realized volatility. And like Don said, 17%, 16%, that's about where the VIX belongs. I think if we get this kind of incremental uptick to 0.8% to 1% a day of movement in the S&P 500.
Yep, and we've talked about this, so we won't beat a dead horse, but it's just going to, and I think we're getting there. It's just going to take this change in mindset where VIX traders and where the public in general has seen those loftier numbers for so long that they tend to think that that's normal. And you point out that it really isn't normal at all. And so once we start to revert to levels of volatility that have prevailed for, 50 years or so, you basically start to realize that the numbers that we're seeing now are very much in line with historical norms. They just don't look that way because people have gotten used to something else.
Speaking of historical norms here, Mr. Schlesinger, what are we seeing out in the land of the old euro?
Well, we actually have expiration today of the front month February contract, and I always like to try to follow up on any forecasts or predictions that I've made, and I'm not afraid to say when we miss by a little bit. I think last week I said I liked the settlement price of about 10.82, and that looked about the right range and just about where we ought to be. But in fact, we dropped almost a full point more. And I think I pointed out that it was kind of like equity types of reactions where the euro was going higher, and yet it was doing so in such an orderly fashion, a little bit every day, that volatility was actually drifting lower in terms of realized volatility. So with just today left, we have the partial volatility of 18 days at 9.92. We dipped under 10. Contract settled at 9.96 yesterday, and so I suspect that it'll be very close to that as we add the last data point today and settle that February contract for expiration.
All right, thank you for that, Mr. Schlesinger. And now we're going to roll right into our Volatility Viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
Welcome to the Volatility Viewpoint segment, and Don and I are fortunate once again this week to have a financial guest joining us for this segment. He is Simon Acomb. He is the director at Acomb Financial Research. Simon, welcome to the program.
Thank you very much.
Now, Simon, let's start off with what we do with all of our first-time guests on the program. Why don't you give our listeners a little overview of your background in the derivative space and then what you do over there at Acomb Financial Research?
Well, thank you very much. Yes, I've had about 20 years' experience running quantitative research teams for some of the major financial institutions across Europe, Asia, and the US, including running a prop trading team for a European bank and the head of analytic modeling recently for Morgan Stanley in the US. I'm now run my own consultancy firm, and I do consultancy advising for some of the major banks on volatility modeling and some of their risk advisory, as well as doing training activities and workshops in the area of volatility trading and risk management.
So I have to ask you then, during your time at Morgan Stanley, did you ever encounter one Don Schlesinger there during your? Did you two ever cross paths during your time?
We didn't until a few days ago when we had a very interesting exchange about what's going on in the volatility space at the moment, and the vast range of structures that are out there and the great opportunities that there are for people to be able to use these new contracts to be able to trade volatility.
I left Morgan Stanley in 1998 on a day-to-day basis, although I still do seminars for them. When did you actually come to the firm?
I came to the firm in 2002.
We just missed by a little bit.
Just missed by a little bit, and I think I took over some of the training that you were doing in Europe. So I came across your name, and everybody was talking well of you, Don.
Did you know Derek Bandine?
Absolutely. Very good man indeed is Derek Bandine, currently at Citigroup, one of the great managers of equity businesses.
And he and I sat next to each other for many, many a year and traded the proprietary options book together before he left to go to London and Canary Wharf.
Yeah, a great trader was Derek Bandine, a great volatility trader, a man of many talents.
You two are like two ships crossing in the night, where you just miss each other on multiple occasions. But of course, Simon, I've took a moment to dive through some of your research of late. I know a big topic of discussion and research for you is correlation and volatility correlation. And you mentioned some of the new volatility products earlier, and let's dive in right there then and get started there with some of these new volatility products, like products that we like to talk about on this show quite a bit, like the VIX and some others that are, what do you make of these products that are being kind of marketed or shown to the world as these sort of inverse correlations, these inverse hedges to your portfolio, portfolio insurance type product, if you wish? Do you see these products offering any real benefits from a correlation perspective?
I think there is some interest in there. I think that the interest there is predominantly amongst fund managers. What's happened with the introduction of all of these new volatility contracts is that we actually have a new asset class that people can trade. People are very used to the idea that they're a fund manager and that they invest in all sorts of assets, whether they be bonds or equities and foreign exchange. And the introduction of new volatility contracts has meant that they can add to those asset classes things like volatility and make volatility something that they can trade themselves. And we're seeing a sort of increasing response from people actually doing this, certainly in Europe and in the US, and using contracts to actually, as a fund manager, to get some additional way of diversifying their portfolio. And one of the great things about the volatility contract, or volatility in general, is it tends to be not very well correlated with other assets. In fact, quite often you find that volatility is anti-correlated with its underlying. And this gives people a real great opportunity to be able to use that contract. So these volatility contracts tend to be anti-correlated with their underlying asset. And that means that you can get a greater range of diversification by using these volatility contracts. And one of the great things that I've been researching, I've been looking at what sort of contracts you can use to get that diversification. So I looked at portfolios containing bonds and equities and the volatility of equity to see what sort of benefits I could get, whether I could get higher levels of return for taking the same sort of risk using Markowitz's portfolio theory. And what you find is that if you've got a low to a moderate risk appetite, volatility does play a very good role in getting that additional return, right, for a given level of risk. And one of the more interesting things was I then asked the question, what sort of maturity of these sorts of volatility contracts do I want to have? If I've got volatility swaps or volatility futures or VIX contracts, do I want to be trading near-dated futures or some of the longer-dated futures? And what I found is that you got better risk-return profiles if you were using some of the longer-dated volatility contracts out there.
Simon, I have a question about this because it's an area of particular interest to me and also to Bob Krause as we go forward talking about some of the very possible widespread uses of our realized volatility contracts. So I'd like to actually press you for a few details on what you just mentioned there. there is a paper written about 5 or 6 years ago by a team of researchers in Brussels, if I'm not mistaken. Mm-hmm. The lead writer was Marie Brugère, if I'm not mistaken. And their findings, similar to yours, were that a volatility overlay on an equity portfolio could enhance the Sharpe ratio by virtue of either keeping returns fairly near the pure equity portfolio return while reducing volatility substantially, or actually altering the returns in a favorable manner. But their research, because at the time it was all that was available, was using the VIX index itself, which of course is not tradable. And in Correct. Their conclusion, they spoke about possibility of future research, which would have been to then take a look at VIX futures that, while tradable, don't always track the VIX index so well. And so the results might have been different. And of course, from our perspective now at the Volatility Exchange, we're extremely interested in knowing what this diversification and perhaps Sharpe ratio enhancement possibilities might be for our realized volatility futures contracts. And so lacking any empirical data for that, because they haven't traded on equity yet, we're looking forward to launching on the NASDAQ very shortly. You mentioned vol swaps, and as our listeners know, variance and vol swaps are virtually always settled to realized volatility and not having anything to do with implied volatility. So a vol swap for the time being would be an excellent surrogate for this kind of research if we had historical data on vol swap pricing and how that might be an overlay to an equity portfolio and what it might do to the Sharpe ratio. So I'm wondering, since you just mentioned it, whether you do have any research or any numbers in that regard, because I, for one, would be very interested.
I don't have the numbers on the volatility swaps, mainly because, as you say, they're OTC contracts and the data is difficult to get hold of. I did my analysis looking at VIX futures, and VIX futures at different maturities rather than just the spot VIX. So the VIX futures are tradable contracts, so there are things that people can actually put on to try and have a look at this sort of trade. And as I say, right, there are two effects that go on here, really. The first one is that diversification effect. So if I think about my portfolio, and it's well known that if I have a portfolio with a mixture between cash, bonds, and equity, I can adjust that portfolio to get the maximum level of return for an optimal level of risk. And that will tell me what sort of mixture of assets I require. And I had a look at what impact that would have if I threw in volatility futures contracts, in this case VIX contracts, at different maturities. And the interesting thing was that the longer dated contracts seem to work better than the shorter dated contracts. And it would be a great piece of work to have a look at, and hopefully, we'll get volatility swap contracts futures trading shortly, so that we can actually have a look to see which works best, whether it's VIX futures contracts or volatility futures contracts.
And one of the things that we hope to do, while of course it takes a long time to build up empirical data and to study such effects, is to perhaps go back and replicate what theoretical pricings may be. Obviously, we can't promise that that's the way the contract would trade in the real world, but there would be a tendency for a realized volatility contract to trade very closely in line with swaps prices, and swaps prices often are priced for whatever the duration may be to match the at-the-money implied volatility of option straddle that might be trading on that particular underlying. And once the contract is put on and you're actually calculating realized volatility, there's a kind of a hybrid calculation for the days that have gone by where you've logged actual or historical volatility and the days going forward that remain in the contract that still might be driven by implied volatilities and where option straddles are trading. So for lack of any empirical evidence, we might approach the study from that angle and see whether or not we can't overlay such a contract on an equity portfolio going back a number of years to see what the effect might be.
Certainly, that would be very interesting. And I said that there were two effects. There was this diversification effect, but the other effect is that when we look at volatility contracts, their reaction to the behavior on the underlying, I said that they had a negative correlation often had negative correlations with the underlying asset. That's not quite true. So most of the people, when they look at these sorts of things, they think about correlation between their volatility contracts and the underlying. And correlation has a number of deficiencies as a statistical measure. And one of the key deficiencies that I think about correlation is it only measures a linear relationship. It only measures the strength of how much the underlying vol contract changes when the underlying asset changes in a linear way. And what you find with volatility contracts is that relationship isn't linear. So particularly in the equity markets, you find that the volatility contract behaves in an asymmetric sort of way.
Absolutely.
So volatility tends to really spike when markets crash. And this means that those volatility contracts offer some sort of crash protection against the underlying market. And that's part of the features that I think it was those guys, certainly somewhere in continental Europe, when they were writing that paper, were thinking about. Right? Can I overlay my equity portfolio with a little bit of volatility contracts to be able to do some sort of crash protection? And yes, that sort of thing is possible, and you get crash protection, right? And it's particularly effective using volatility contracts because they tend to overreact in these crisis sort of situations.
Well, it brings up a very interesting point of if, in fact, you were to engage in this activity, exactly what kind of ratio or what percentage of assets under management, assuming that we're talking about equity for a moment, you would actually do with the volatility contracts. And as you very correctly point out, the bit of the challenge, if you will, in coming up with the correct number is that if you tell me ahead of time if the market is going to go up or down, I'll have a good idea of what that ratio may be. But just establishing a new position makes it a bit of a challenge, because if you say on the first day the market is going to go up about 2%, I might think there would be somewhere of a 3 to 4 time ratio, and a VIX or a volatility contract might move 6 or 8%. But if you tell me the market's going to go down 2%, that leverage effect that you just mentioned, the volatility contract may go 7 times that or 8 times that. So we have that asymmetry, and one size fits all becomes a little bit challenging in terms of coming up with, for lack of a better word, a perfect hedge or any kind of a correct overlay. So I think those researchers actually did try to enhance a static, just buy it and hold it type of philosophy, and they try to use mean reversion and say, why not trade around this a little bit, and when volatility is historically very low, that may be the time to load up a little bit more on such contracts. And when it's at the high range, which in fact usually happens after the market has dropped substantially, maybe that's the time to lighten up a little bit and expect reversion to the mean with lower volatility, which might mean that the market would spring back a little bit. So wondered if you had some experience with that in your research and whether that goes along the same lines of your thinking.
Sure. There's an awful lot of research going on this area, and the mathematics on this stuff gets fairly complicated very quickly, and different people have different ways of trying to think about how to model both how volatility and the underlying asset behave at the same time. And I think one of the more interesting things that people have realized post 2008 is that when we have these panics and crashes in the market and we have these overreactions on the volatility contracts and the VIX contracts, that what happens is once we have one bit of a crash and one bit of sudden movements in the underlying, that it's a lot more likely in the next few weeks that we'll have further panics and crashes. So these sorts of things that you're right, you're saying is, okay, there's some sort of mean reversion going on in there, right? And that when you've got very large levels of vols, they tend to come back down. And when you've got low levels of volatility, they tend to go back up, right? But there's also another factor going on in there, that when I have crashes, once I've had one crash, it's more likely that I have others. So it adds to the further complexity of this picture. I think you're right, that in order to get a good mechanism for adding volatility to your portfolio, it's not as simple as just buy, hold, and sit there and wait and see what happens. Some dynamic trading can be very useful.
Yeah, I think. And Simon, I was a little interested in kind of your study of VIX futures and where you found the most value. You know, how did you manage the duration problems that are associated with VIX futures? And, you know, did you find issues with that made using VIX futures as a hedge? And how did they perform relative to things, say, like out of the money puts in major market indexes, different things like that, where they've got the directional and the volatility component kind of wrapped up into one? I'd be kind of interested in how you approach those two aspects of your studies.
So I haven't actually looked at comparing the VIX against those put contracts, but I think you raise a very interesting point about the VIX contracts and why it is that it's some of the longer dated VIX futures that work better in some of these diversification strategies. And part of the problem, as you say, right, you called it a duration problem. And this is a problem that actually the people who understand this best are actually commodities traders. So there's a whole set of indices out there on commodities issued by Goldman Sachs, right, where you roll your futures contract, right, as the future contract comes up to expiry to keep a constant duration.
Yes.
And that is what I was doing with my VIX contracts.
So did you find contango to be an issue when you were doing that?
Absolutely. And that's why the longer dated futures work an awful lot better than the shorter dated ones, because the contango is less pronounced at the longer dated contract maturities than it is at the shorter dated ones. So you can get round some of the contango issues that constantly you're riding down the contango curve and losing money by rolling your futures by taking futures at a longer maturity. And this seems to be a good way of trying to circumvent some of those issues.
So you get kind of this so you would say that you get this give and take where maybe you lose a little bit of reaction to price shocks, but it's worth it in that you're not paying this constant charge to roll back your futures. Is that kind of what your conclusion was?
That was my conclusion. And I think, it's going to be very interesting to see as the range of these contracts out there increases, right, it will give further opportunities for people to look at the diversification effects using some more of these different contracts.
Simon, I know we discussed briefly the other day that you had in mind for contracts such as the realized volatility futures that we will come out with on equity and perhaps other assets as well, several major uses that you thought would appeal to the investment community. Now, we've discussed in pretty much detail one of those, but I know you had a few others, And I wonder, in the time that we have remaining, if you might touch upon some of those other areas where you found that such contracts could be extremely useful.
Yes, certainly. So we talked a lot about how a fund manager, somebody who's managing a portfolio of assets, can use these contracts. But whenever I think about volatility contracts, I think about them as having four major users of these contracts. We've talked about the regular investors. Everybody immediately thinks about people who are making markets in derivative contracts. But of course, we miss out the proprietary traders and people who have a view. So as we've discussed, and I'm sure you've discussed extensively before, volatility has a very rich set of dynamics. It has both correlation with the underlying asset. We have a volatility behaves differently at different maturities. It trades differently across some of the different asset classes. So just by introducing both volatility contracts and VIX contracts, all of this rich set of contracts that are out there, it gives an awful lot more opportunity for proprietary traders to actually get in and do some trading. And this can be whether it's taking a relative view on the volatility between two different assets. So you could go long some sort of volatility or variance contract on one asset and short another to exploit that view that you think one's going to move relative to the other. Or it can be to take a view on volatility at different maturities. So you can actually do some sort of calendar trading in volatility trading, and it allows people to have an awful larger view about how those things can trade. But what interests me most of all, and I think life gets incredibly interesting, is the richer the set of the contracts that are out there, the more complex the relationships between those contracts. And that gives increasing opportunity for ever more sophisticated arbitrage between those contracts. And that's some of the things I know that we talked about, some of the things that part of the work I do is doing consultancy and training and workshops. And that's some of the things that we try and explore in some of those workshops, is how you can actually exploit the arbitrages between the two different sorts of contracts. And one of the interesting things that people know about, or know reasonably well about, is that there is an arbitrage. The value of a variance swap can be simulated using options on the underlying asset. And so you usually end up with arbitrages that people put on between the values of variance swaps and the value of options on the underlying asset. And what becomes more interesting is, as these things get richer and richer and richer, there becomes all sorts of more interesting arbitrages that you could put on. For example, there also exists arbitrages between VIX options and variance swaps, which is something which starts to increase the range of possibilities that people have to try and exploit those arbitrages and put on proprietary trades.
I know you mentioned in quite a bit of your research, Simon, that you're a big proponent of variance swaps. They keep popping up in a lot of the papers that I read, a lot of your papers that I read, and a lot of the comments I saw from you. You tend to coin them as the most objective way to trade correlation. And I'm curious to dig into that a little bit. Why are you such a proponent of variance swaps? Is it because they're not really that strike dependent, so you can get a little easier way to trade correlation in that sense?
Yes, absolutely. One of the big issues in terms of trading correlation between assets is if you use things like straddles or other sort of option strategies, then that exposure to the volatility of that individual asset sort of goes away when the underlying spot moves. So using variance swaps or any other sort of volatility type contract increases your ability to be able to do that, because you don't have that strike dependency going on. I always think about variance swaps as being the raw material that you use to order to be able to do lots of these sorts of variance trades and these correlation trades. And then, we've added to the sophistication and the toolbox of our traders by introducing all sorts of new contracts, whether they be VIX futures or volatility contracts or whatever they are, to be able to increase the range of opportunities that they have to be able to do this sort of correlation trading.
Well, Simon, I know we could probably go on for quite a while talking about some various topics. I know there are quite a few topics I would enjoy picking your brain about going forward, such as your interpretations of skew and the volatility smile and the origins therein. But we are
that would take many, many days, not a half
exactly,
hour.
Exactly, and that would follow up on an interesting conversation we had on the last show with our previous guest. But we'll have to save that for another day, unfortunately, because we are running a little bit long on time. But before we go, I know you have an upcoming symposium in New York that I think may interest a lot of our listeners. So why don't you give us the details on what you have coming up?
Yes, certainly. So London Financial Studies, somebody who I am on their faculty and on their faculty and do an awful lot of training for, we're running a volatility workshop where we're going to study over 3 days how volatility can be traded and how you can use volatility in your risk management process. And that's running from the 14th to the 16th of May in New York. And there are details of this course on the Volex website at www.volex.us. And for people who are booking through that website, there will be a 15% discount. And on that course, we'll go through some of the practical details about how this large panoply of contracts can be used by both traders and investors to increase their opportunities to be able to produce money-making portfolios or looking at the arbitrages and the trading opportunities that exist out there. So hopefully, some of your listeners would enjoy that sort of course. As I say, all available for all of your members to sign up on your website.
And I would urge listeners to go ahead and take a look at that offering on the site, simply because over the 3 days, there's an incredible wealth of material that's going to be covered, and the syllabus is outlined in great detail. It would take too long to read all of the topics at the moment, but it's an awfully impressive course. I've seen a lot of these courses. I've actually given some of them myself, and this is an extremely impressive syllabus, and the amount of material and the depth of the study to be done over a 3-day period is quite frankly amazing. So our listeners and anybody interested in learning a great deal about the volatility process should have a look at this.
Simon, thank you very much for coming on the program, and I echo Don's sentiments. All of our listeners should definitely surf on over to volex.us and check out those course materials for themselves and register for the workshop, because it'll be very interesting. If you're interested in what we talk about on this program every week, then this symposium, this lecture series is definitely right up your alley. So thank you again for coming on, Simon, and we'll definitely have to bring you back on the program again down the road.
Thank you very much. Good to talk to you.
Thank you, Simon.
And that's going to do it for the Volatility Viewpoint. And now we're going to roll right into our Crystal Ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball segment. This is, of course, the portion of the show where we peer deep into the murky ether of the future and attempt to divine what the volatility gods have in store for us for the coming week. And we'll start, as we are wont to do here on Volatility Views, with the old land of S&P volatility. So, Mr. Sebastian, what do you see in your crystal ball? I have a feeling it's going to be something along the lines of what we just discussed earlier in the Volatility Review.
I don't see a lot more decline in VIX at this point. I've been kind of setting 17% for a price target for some time. I think that's about right. Maybe, the 15.5 to 18.5 range seems about right. I think that there's going to be a major flattening of the VIX yield curve. I think, our gentleman friend, Simon that just spoke, we have some of the steepest long-term contango in VIX futures that I've ever seen. The July, the summer contract, the July contract is trading at almost a 9-point premium to cash VIX. That over 50% of the value. That is absolutely insane. If I was looking to play any type of volatility play, I think it could make sense to isolate the gamma and short, isolate gamma and short VIX using S&P versus VIX options or S&P versus VIX futures, some combo of the two, because I think that you can get the gamma for a lot cheaper than where that VIX future is pricing. When I look at S&P 500 at, let's say, like the June contract, let me see if I have I don't think we have a July contract right now in SPX. That is a serial month, so we do not have it. I've got the June quarterly. The June quarterly right now is trading at a volatility of about 18%. You can buy the at-the-money straddle at about 17.4. Don, how would you feel about buying a June contract in S&P 500 where you get the gamma and the volatility for about 17.5%, and then going in and selling the VIX contract and getting 25%? You think there's a trade there by chance, my friend?
Don is not one to enthusiastically endorse buying premium in any scenario, I don't think. So
well, this is
he's stunned into silence.
Well, here's the thing. I look at something like that and I say, yeah, it's a terrific spread, and then of course I'm always leery with the VIX products because I look at the 25 and I say to myself, well, sure, that sounds much too high to me. But then nobody ever guarantees me that they're going to settle to anything that's actually real or measured. So I always worry a little bit that they can keep it there as long as they feel like keeping it.
I don't think you have to take that contract into settlement is my point. You can buy the S&P 500, sell like VIX calls. There's going to have to be a meeting there somewhere, right?
Yeah, right.
I don't think it's going to be – if we get a pop, that S&P contract's going to move a lot more.
I agree.
But, and this is actually what's going to be so cool about that NASDAQ product is that I think that is going to offer some incredible ways to take advantage of the realized versus implied, because I just don't see how that risk premium in realized volatility is going to be priced in exactly the same way as the way the VIX futures price in. And there should be some really fun back and forth with those two contracts.
Yeah, and we've talked about how it might trade from a theoretical viewpoint for quite some time, but until you actually get out into the marketplace and see how it's going to be traded, all you can do is kind of speculate according to your knowledge of what's going on. But the traders have the ultimate final word, and I'm like you. I'm really very eager to see exactly what those differences and similarities may be.
That's one of the great things about me is I have very little knowledge and a love of speculation. So it allows me to really do a lot of things.
You're perfect for radio in that sense.
Yes, that's exactly right. And so I've been put in a great position to basically be able to run my mouth without any consequences. So you know what I need to do, Mark? The only thing I don't do
we'll
yet
hook up a little
is
electric
ask
zapper.
myself rhetorical questions yet that nobody would possibly answer. Is the VIX trading 17? Yeah, the VIX is trading 17. Is it low? Yeah, you know what? It's low relative to where it's been. Could it go higher? You know what? It could go higher. I need to get into that half of the radio voice.
You'll learn that soon when you need to fill some time. If you're hosting a show someday and you need to fill some time.
Yeah, you know what, Mark? We do need to fill some time.
Rhetorical questions can be useful in that sense.
Let's talk about radio voices.
but tell you about. We'll add some consequences for you. We'll add a little buzzer to your cheer, so we can give you a little electroshocks, myself and Don, if you start waxing nostalgic or anything along those lines. How about that? That'll add some stakes to the game.
Fair enough, my friend.
And speaking of adding some stakes to the game, let's do it this week, Don. Let's buy some islands in the Bahamas for our listeners here with some deeply insightful Euro vol picks. What say you, sir?
Well, they're making it hard for me because here we are in the settlement day, and we're right around that 10 range, and so we now go to the next contract, which is the March as the front month, and settled at 11.72 yesterday, as these contracts usually just, reflect those implied volatilities that are somewhat higher. So, taking a look at the actual levels of vol of euro lately, 11.72 certainly looks a little bit on the high side to me, and forecasts from our friends at the Volatility Institute are more in the 1060 to 1070 range. So I might say a little bit lower going forward. But there's an interesting point to be made when we talked about movement. You often think about when you're predicting volatility, when Mark talked about, what is 20 mean, what does 18 mean in terms of percentage movement on a daily basis. When you have a 10 volatility for the euro, when 1% daily is a 16 vol, 10% annualized volatility is just 10/16 or 5/8 of 1%. When you take 5/8 of 1% of the euro price of about $1.30 or $1.31, you get around 82 hundredths of a cent. In other words, not quite a penny a day, about 82 hundredths. And yet, if you get that kind of movement every single day, you can get considerable price change in the actual underlying, but, without a great deal of volatility. It just depends on if it's one-way kind of action. And that's what we seem to have seen recently in the euro, namely that the price was appreciating, and by, about 700ths, 800ths of a percent every day, people are looking, saying, wow, the euro's really going higher. But from a volatility viewpoint, it was only 10 or even sub-10 volatility because it was doing it in a very orderly fashion. So sometimes you have to disconnect your viewpoint of direction from your viewpoint of volatility. They don't always mean the same thing. People may say, gee, there's news out of Europe, the euro's going to go higher. It may very well continue to go higher, but not necessarily translate into that much higher volatility.
Can I just say, Don, on a personal level, how excited must you be to be looking forward to adding some NASDAQ prognostication to the mix here very shortly?
Well, I think it'll open up a whole new dimension for everybody. And my background was, of course, in equity and in equity options and index options trading. Yeah. So the ability.
Can you imagine Don being able to sell premium on being shorty at the same time? I think his head will explode.
See, this is a problem. I can only talk about it.
Being sold to you.
Because they won't let me do it in the real world. So all I can do is talk about it. We'll let you do the trades, Mark. Okay?
Sold to you twice.
All right, and with that sentiment, that's going to do it for our Crystal Ball segment. That's also going to do it for this edition of Volatility Views. We, of course, want to thank our guest, Simon Acomb, for joining us today. And, of course, listeners should surf on over to volex.us to check out that course and register and get that discount if you are indeed going to be in the New York area and are interested in those types of topics. I'm guessing, since you're listening to this show, that you probably fall into that camp. All right, and before we go, Mr. Sebastian, what is coming up in the land of optionpit.com?
Well, we've got a webinar on trading stock earnings on the 15th. And coming up in March, if you are going to be in the New York area, myself in conjunction with TheStreet.com and the SIBO, we're going to be doing Trading the S&P 500. We're going to talk about trading S&P 500 futures, futures options, spiders, SPX, SPS PM, the entire complex of the S&P 500. So we're really looking forward to that, and we think it's going to be a great time.
And they can register for that at optionpit.com, I assume.
No, go to. I think it's going to be through the CBOE. We are dotting we are crossing the T's and dotting the lowercase J's right now. But everybody, what's going on out there? So that's going to be a fun event.
Sounds like it. Well, thank you for that, Mr. Sebastian. You may now go about your merry way. And before we go, Don, what, aside from that course, that Simon's course, which sounds very interesting, what else is going on in the land of volex.us?
Well, we're actually gearing up for the trading of the NASDAQ contract, and we're doing a systematic review of all of our databases to make certain that they correspond to the methodologies that we'll use to actually disseminate the volatilities. We've been speaking to a great many market makers and order flow providers, getting everything ready to gear up for the trading, and we still have a decision to make as to whether the underlying will be the NASDAQ futures or the NASDAQ cash. We're starting to get a feeling towards the actual cash index, and so we're making sure that all of our historical data and all of the charts and the information that we provide will actually be consistent with the methodology that'll be used. So I was happy to hear that Bob Pisani is taking a look at what's going on there, and we've got a wealth of information on the site for people to look at.
All right, and thank you for that, Don. And of course, if you want to hear more about any of the topics we discussed on the program today, or check out any of our previous episodes of Volatility Views, then surf on over to theoptionsinsider.com. You can find all of that information and much more. Of course, you can also find the audio just by surfing into iTunes and searching for Options Insider or Volatility Views. You'll find all of our programs there as well. So that is going to do it for this episode of Volatility Views. I, of course, want to thank all of you out there for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.